The dollar in your wallet is not powerful because the paper is impressive. It is powerful because for half a century the world helped hold up the arch above it. That is where most people start too late. They start with a headline about BRICS, or a clip about China, or a scary chart about gold, or a dramatic sentence about the petrodollar dying. That is not where the serious story begins. The serious story begins with the structure. Every lasting system rests on a hidden support. A bridge can look graceful, but what matters is the load path. A cathedral can look eternal, but what matters is the stone that keeps the arch from collapsing inward. A reserve currency can look natural, even inevitable, but what matters is the keystone for the dollar. The keystone was not just confidence, it was oil. And if you do not understand that, you do not understand why your savings have worked the way they have, why American borrowing has been so strangely easy, why deficits that would cripple other countries look survivable here, or why a slow change in the plumbing of global energy trade can eventually show up in your grocery bill, your mortgage rate, and your retirement statement. That is the story, not a dramatic overnight collapse, a shifting keystone. And once a keystone shifts, the arch does not always shatter at once. It begins by carrying weight differently. That is what I want you to see. The petrodollar system did not just make America rich. It made ordinary American assumptions feel normal. Cheap borrowing felt normal. A giant treasury market felt normal. A permanently useful dollar felt normal. A life built on imported abundance felt normal. That word normal is expensive because most people use it when they mean subsidized. The petrodollar system quietly subsidized the American way of life for decades. It gave the country a monetary privilege so large most citizens never had to learn its name. They only lived inside its benefits. That is how empire works when it is functioning. Well, the public mistakes structural privilege for natural order. I have spent most of my life studying what happens when systems look permanent long enough that people stop asking what is actually holding them up. That is when the danger begins, not when the first crack appears, but when nobody remembers where the weight is being carried. So let me say this as plainly as I can. The dollar was not backed by good feelings. After 1971, it was backed by a geopolitical and energy settlement that forced demand for dollars through the bloodstream of global trade. That arrangement became the keystone in the American financial arch. And while the arch still stands, that keystone is no longer as fixed as it once was. That is the real issue. Not whether the dollar dies tomorrow, whether the support underneath it is loosening enough that the costs of American life begin rising, in ways the public still does not connect to the original structure. The source document behind this story opens exactly where it should. It points to a dollar bill, reminds you that there is no gold or silver behind it, and then asks the only question that matters. Why does the world still accept it so easily? Its answer is oil. And that answer is essentially correct. The petrodollar system has been one of the main reasons the dollar retained extraordinary power after gold was removed from the picture. Fayfala cite Fayturn 56 file 0 Fay, that is where the keystone enters. Before oil, there was gold. Bretton Woods in 1944 gave the world a post-war monetary architecture. The dollar sat in the center, other currencies were pegged to it, and the dollar itself was fixed to gold at $35 an ounce. America had the industrial base, the geopolitical power, and the gold reserves to make that system believable. Believability is everything in money. People think money is math. It is partly math, but money also lives on trust. Bretton Woods worked because the math and the trust lined up closely enough for a while. That was enough. Then came the old disease of reserve issuers, too much spending. Too many claims, too much confidence that the issuer could stretch farther than the anchor. Vietnam mattered. Domestic spending mattered. Foreign governments asking harder questions mattered. France mattered. The gold started leaving because countries did what the rules permitted. They converted dollars into metal. That is what happens when an anchor stops being theology and becomes accounting. Accounting is merciless. The source walks through this sequence cleanly. The late 1960s pressure, the gold rain, and the fact that by 1971 the arithmetic behind dollar convertibility simply stopped working. Fay file cite Fayturn 56 file 0 Fay, then Nixon broke the link. That is the first great lesson. A currency can survive the loss of one keystone only if another keystone is found quickly enough. 1971 was not just the end of gold convertibility, it was the beginning of an urgent search for a new support beam. If the dollar no longer had metal underneath it, then something else had to force the world to keep wanting dollars, not liking them, needing them. That something became oil. This is what Henry Kissinger understood better than most people reading history backwards. When the 1973 oil shock arrived, he saw not just a crisis, but a chance to reset the system. Saudi Arabia needed security. America needed a new monetary anchor. The 1974 Blair House arrangement between the United States and Saudi Arabia became, in practical effect, the keystone stone that replaced gold. Saudi oil would be sold in dollars. Excess oil revenues would be recycled into U.S. treasuries and other American financial assets. In return, the United States would provide military support and political cover. Other OPEC countries followed. By 1975, the dollar had effectively become the ticket you needed to enter the energy market. Fe-Filicite Fe-Turn 56 File 0 Fe that changed everything, because once oil was priced overwhelmingly in dollars, every industrial economy had to keep dollars on hand. Japan needed them, Germany needed them, South Korea needed them, India needed them, China needed them. If you wanted to keep your economy running, you needed access to dollar liquidity. That created constant external demand for the currency. Then the oil exporters receiving those dollars could not consume all of them domestically, so they recycled them back into U.S. government debt and American financial markets, out and back, out and back. That recycling loop became one of the most elegant monetary machines ever built. The source describes this flow very well. It explains that countries needed dollars to buy oil. Gulf producers accumulated those dollars, and then large portions came back into U.S. treasuries, equities, and financial assets. That recycling is not some side note. It is the hidden engine that helped keep American borrowing costs lower than they otherwise would have been and made the dollar far more than a domestic currency. Fe-Filicite Fe-Turn 56 File 0 Fe. That is why the petrodollar was not just a technical arrangement, it was imperial plumbing, and plumbing matters more than speeches. The public rarely understands plumbing because it is invisible when it works. They only see the water. They do not see the pressure system behind it. In this case, the water was American fiscalese. Cheaper borrowing, a deep treasury market, lower interest rates than a country with that level of debt might otherwise have enjoyed. A stock market buoyed by continuous international appetite, a government capable of running deficits that would have broken a smaller, weaker, less central country. That is the exorbitant privilege. The source refers to, it cites estimates that the privilege is worth hundreds of billions of dollars a year, and notes that treasury yields may run meaningfully lower because of reserve. Currency demand, these are not footnotes. These are the quantitative shape of the keystone. Fe-Filicite Fe-Turn 56 File 0 Fe. A lot of Americans still do not understand what that means in human terms. It means your mortgage rate has not been determined only by your local banker or your personal credit score. It means your retirement account has lived inside a market structure inflated by international demand for American assets. It means the government could borrow more easily than most citizens realize. It means imported goods arrived inside a system that assumed the rest of the world would keep needing the unit America itself could create. That is a huge advantage, and huge advantages make people careless. Once a privilege has been in place long enough, the beneficiaries stop seeing it as privilege. They call it strength. They call it confidence. They call it the natural superiority of their institutions. Maybe some of that is true. But even superior institutions can be enjoying a structural subsidy. That is what the petrodollar was. A subsidy, a quiet one, a global one. Now let us talk about erosion, because this is where childish conversation begins. Children ask, is the dollar finished? Adults ask, is the keystone less secure than it used to be? Those are different questions. The source gives the right numbers to think with. It says the dollar once accounted for roughly 85% of global foreign exchange reserves and now sits around 57% by 2025. It also notes that the dollar still dominates trade invoicing and still appears on one side of the vast majority of foreign exchange transactions. Both things can be true at the same time. Still dominant. Less absolute, still central, less monopolistic. That is exactly how keystones loosen. They do not vanish in a press conference. They lose exclusivity one margin at a time. Fay file site fay turn 56 file 0 fay. That margin matters more than people think. A monopoly does not need to disappear in order to become less comfortable for the monopolist. If reserve share falls from the mid-80s to the high 50s over decades, that does not mean the dollar is finished. It means the arch is carrying more stress than before. It means alternatives are growing in importance. It means the United States is still first, but the distance between first and untouchable is widening. That is expensive. Not today in one dramatic invoice over time, in many small invoices. The first invoice is inflation pressure. The source makes this point directly. As long as the rest of the world needs huge quantities of dollars, the supply America creates can be absorbed with less damage than would occur in a smaller, less privileged economy. But if global demand for dollars gradually weakens, then additional dollar creation has less foreign absorption working for it. That means more pressure comes home. Imported goods cost more, purchasing power slips. The same nominal savings buy less life. Fay site fay turn 56 file 0 fay. This is the part people misunderstand most. They think a weakening monetary order means the account balance changes first. It usually does not. The account balance can sit there looking calm while the purchasing power inside it decays. That is how hidden losses work. If you have $1 million in savings and the dollar weakens in real terms, the statement can still say $1 million. The damage appears at the grocery store, at the travel counter, in energy costs, in imported goods, and in how much less your retirement income actually buys. The source says exactly that. A visible nominal balance can conceal a very real invisible purchasing power loss. Fay site fay turn 56 file 0 fay. That is why I care about units, not balances. Purchasing power is what matters. Money is not a scorecard. It is command over real goods and future time. If the keystone weakens, command weakens with it. The second invoice is interest rates. This is equally important and even less understood. The petrodollar system did not just support the dollar in an abstract sense. It helped support the treasury market by creating recycled demand from oil exporters and other dollar-holding nations. If that demand weakens, the U.S. government has to work harder to attract capital. Working harder means paying more. Paying more means higher yields. Higher yields on government debt do not stay in Washington. They pass through the system, mortgage rates, car loans, credit lines, corporate borrowing, small business financing, everything the source points to the scale of the U.S. debt burden and notes that rising rates on a debt to GDP ratio around 119% become more painful as the old recycling machine loses power. That is correct. A country with a huge debt load can tolerate a great many things. What it hates is losing cheap funding. Faithfully cite fay turn 56 file 0 fay. That is another reason. The keystone matters. It was holding down the cost of debt for an entire civilization. And when the cost of debt rises, it does not only hurt Wall Street, it changes household math. A family deciding whether to buy a house, a business deciding whether to expand, a retiree deciding how to ladder fixed income exposure, a government deciding how much deficit pain it can politically survive. All of them begin living in a world with less room. Less room is the best way to describe what a loosening keystone does. It does not instantly destroy the building. It makes every movement inside it more expensive. Now let us talk about the third invoice, retirement and asset prices. The source points out that Gulf sovereign wealth funds and other foreign investors have parked enormous sums inside American financial markets. If the recycling process of petrodollar surpluses weakens over time, then that flow becomes less reliable. Lower structural demand for U.S. stocks and treasuries can mean lower valuations and a more hostile environment for the retirement accounts that assumed endless foreign appetite for American assets. It also notes that foreign ownership of treasuries has already fallen from above 50% during the global financial crisis to around 30% more recently. Fe Falicite Fe Turn 56 File 0 Fe. That is not a trivial trend. Retirement systems live inside valuation regimes whether people understand them or not. If your 401k IRA or brokerage account has spent years inside a world where the United States enjoys unusual reserve currency support, then a world with less of that support is not just a macro headline. It is a different return environment. Notice what I did not say. I did not say returns vanish. I said the regime change is enough. The fourth invoice is geopolitical leverage. This is the one most people dismiss because it sounds too abstract. It is not abstract at all. The source says one of America's most powerful foreign policy tools is the ability to weaponize access to the dollar system, freeze reserves, cut entities off from SWIFT, impose sanctions with real force, because the dollar-centered system is still the central nervous system of trade. That power exists because there are few substitutes with equal scale. But the more countries build payment systems, trade arrangements, and reserve habits outside the dollar structure, the weaker that tool becomes. Fe Falicite Fe Turn 56 File 0 Fe. The Russian reserve freeze after the invasion of Ukraine accelerated this insight for the entire world. You can approve of the policy and still understand the financial consequence. Once countries see that reserve assets can become geopolitical instruments, they begin asking whether a politically exposed reserve asset is really the same thing as a neutral reserve asset. That question alone changes portfolio behavior for states. And state portfolio behavior is what moves keystones. The source cites China SCF system, Russia, China settlement and local currencies, local currency trade by India, Pakistan, Iraq, and the UAE, and the mBridge digital settlement network built by major central banks. It also notes that Saudi Arabia joined mBridge in 2024. That matters not because these systems have already dethroned the dollar, but because serious countries do not build alternatives for entertainment. They build them because dependence now looks riskier than it used to. Fe Falicite Fe Turn 56 File 0 Fe, that is the fifth invoice. The slow devaluation of certainty. This is where ordinary investors make their biggest conceptual mistake. They hear about BRICS or the yuan and imagine some clean replacement contest. Dollar versus yuan. Winner takes all. That is childish. The world does not need one dramatic challenger with equal power tomorrow. It only needs more pathways that reduce compulsory dependence on the dollar. A little more trade in local currencies here, a little more gold there, a little more cross-border settlement. Outside SWIFT, a little more reserve diversification by central banks, a little more willingness by Saudi Arabia to keep options open. The keystone does not need to be removed. It only needs to stop being the only stone that can hold the arch. That is enough to change the cost. The source is balanced on this, and I intend to preserve that balance. It acknowledges that the alternatives are still small. The yuan remains a very limited share of global reserves. India's foreign minister openly said India is not pursuing de-dollarization in the way the internet imagines. The dollar still dominates oil trade, reserves, invoicing, and foreign exchange. U.S. capital markets remain vastly deeper than any alternative. The legal system still offers protections that no rival has fully matched. The shale revolution changed the original energy dependence dynamic without immediately ending dollar dominance. All of that is true. Fe Falicite Fe Turn 56 File 0 Fe Good. Serious people can hold two truths at once. The dollar remains dominant. The petrodollar keystone is still loosening. Those are not contradictions. They are the structure. And structure is what matters. One of the most useful pieces of evidence in the source is the central bank gold buying. It says gold's share of global reserves rose sharply in recent years, and that central banks have been buying over 1,000 metric tons a year for several years in a row. That behavior matters more than speeches. Institutions do not buy gold like that because they think the current dollar-centric order is eternal and perfectly neutral. They buy it because gold is the reserve asset that does not require someone else's political permission. Fe Falicite Fe Turn 56 File 0 Fake gold is not the story by itself. It is the X-ray. It reveals how the most serious actors are thinking. If the keystone felt perfectly secure, they would not be acting like this. This is where the emotional temptation becomes dangerous for ordinary people. Some will hear all this and want to turn it into a prophecy of total collapse. That is foolish. Others will hear it and cling even harder to the old comfort that nothing meaningful can change because the dollar is still first. That is equally foolish. I am not interested in either mistake. I am interested in repricing. If the world is moving from a unipolar monetary structure toward a more multipolar one, then the dominant reserve currency does not need to disappear to become less generous to its home population. Lower seigniorage, higher borrowing costs, more inflation, less fiscal room, smaller margins for error. Those are all real costs, even in a world where the dollar remains number one. That is the adult framework, not death, not immortality. Repricing: when a man gets used to eating at a subsidized restaurant for 50 years, the restaurant does not need to close to change his life. It only needs to start charging closer to the true cost of the meal. That is what a weakening keystone does to the United States. It starts charging closer to truth. That truth arrives as higher prices, higher financing costs, a weaker cushion under deficits, more fragile purchasing power, and a retirement environment that may no longer enjoy the same automatic foreign support it once did. That is why the petrodollar story is not some exotic macro curiosity. It is family finance in disguise. The family does not see the keystone. It sees the mortgage, quote, the grocery bill, the airline ticket, the portfolio multiple, the value of a fixed income stream, the purchasing power of cash. That is where the story becomes real. The source closes with the right kind of caution. It says this is not about panic, it is about preparation. It suggests asking how concentrated your savings are in dollar-denominated assets, how exposed your income is to inflation, and how vulnerable variable rate debt might be if rates stay higher. Those are exactly the right questions because they shift the conversation from television drama to household arithmetic. Fay file site Fayturn 56, file 0 Fay. That is where I want you living. In arithmetic, not slogans, not social media prophecy, not blind faith in permanence. Arithmetic asks, what happens if the dollar remains dominant but less dominant? What happens if inflation is slightly more persistent than you expected? What happens if Treasury funding gets incrementally more expensive? What happens if imported life costs more? What happens if your assets are entirely concentrated in one monetary order that is still strong but less sheltered than before? What happens if your fixed income is fixed in nominal terms while the purchasing power underneath it erodes? Those are adult questions, and the answers do not require a catastrophe to matter. They require only gradual change. That is what makes the whole thing so dangerous. Gradual change lets people keep denying while they are being repriced. It lets officials keep using words like stable while the keystone moves a little more each year. It lets savers hold the wrong structure because the pain does not arrive in one theatrical burst. It arrives in small bills. That is how empires get less generous, not necessarily less grand, less generous. And that is enough to change a life. Now let me say the hardest thing plainly. Most Americans still think their standard of living was earned solely by domestic productivity, innovation, and political virtue. Those things mattered. But the arch was also held up by a monetary arrangement that made America's paper uniquely necessary to the rest of the world. That arrangement is no longer as exclusive as it once was. Once you accept that, you stop asking whether the dollar falls off a cliff. You start asking what parts of your own life have been priced on the assumption that the keystone would never move. That is the right question. If your savings, your bonds, your debt, your retirement plan, and your sense of security all assume the same monetary order remains as frictionless as it was in the peak petrodollar decades, then you may not be fragile in the obvious sense. You may be fragile in the structural sense. The kind of fragility that looks fine until the supporting stone shifts another inch. And when it shifts another inch, the arch does not ask for your opinion. It asks for adjustment. That is where we are now, not at the collapse of the arch, at the point where intelligent people should stop admiring the stone and start measuring its movement, because movement is real. The reserve share is lower. The alternatives are broader. The sanctions lesson is burned into every central bank's memory. Gold buying is no longer subtle. Saudi Arabia is not leaving the old order theatrically, but it is no longer pretending exclusivity is wise. China is building plumbing. Russia is living outside the old pipeline as much as it can. France settling an LNG deal in yuan matters not because it is large enough to overturn the order, but because it proves the stigma around non-dollar settlement is falling. That is how keystones loosen. One non-dramatic precedent at a time. So here is the final choice. You can keep treating the petrodollar as a fascinating historical anecdote that has nothing to do with your checking account, your 401k, your future borrowing costs, or your purchasing power. Or you can do the more mature thing. You can recognize that for 50 years, a hidden support helped make American money feel stronger, American borrowing feel cheaper, and American deficits feel more survivable than they otherwise would have been. And you can recognize that this support is no longer locked as tightly as it once was. That recognition does not require panic. It requires clarity. Clarity about inflation, clarity about rates, clarity about diversification, clarity about fixed versus variable liabilities, clarity about what cash really earns in real terms, clarity about what gold buying by central banks is signaling, clarity about what it means when the rest of the world starts building options. That is how you defend yourself in a changing monetary order. Not by shouting collapse, by pricing the drift. The keystone is still there, the arch still stands, but the stone is moving. And people who keep pretending it is not will wake up one day to discover that the cost of their life changed long before the architecture officially admitted it. That is how monetary change really arrives. Not as a televised ending, as a different bill, a different yield, a different mortgage, a different retirement, a different dollar, and by then the only people who will still feel surprised are the ones who mistook the arch for nature and never bothered to ask what was holding it up.